Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. The latest data on U.S. retail inflation supports the case for another Fed rate cut next month. A bit later, we'll be joined by Carey, portfolio manager at the Carnegie Investment Council. We'll begin by looking at today's price action with Nicola, Bloomberg M-LIV strategist. She joins us from our studios in Singapore. The bond market is still reacting to President-elect Trump's victory and the implication that we're going to see a lot more in the way of inflationary pressures building, more so at the long end than the short end. And what the backup in yield has done at the same time is strengthen the dollar quite a bit. The Bloomberg Dollar Spot Index was up today by 0.4%, and I think the index has been up for 5 of the past 6 trading days. Can you see any end in sight for this rally that we have seen in the dollar?
Yeah, it's interesting. I was thinking about today what would trigger a reversal in the dollar. And I think one thing would come is likely, let's say you get a weak labor market data. That could be one thing that could come through. But for now, it looks like everyone's so focused on the Trump administration, the potential policies, tariffs, especially in this part of the world, and what are the implications from tariffs here. Of course, last time we still remember what happened in 2018-19 and the implications on the CNY and how much it weakened and how much currencies across Asia had weakened as a result. So there's still that overhang and that cloud that's really overtaken the region of what happens next. And of course, because the new Trump administration has come in with a lot of China hawks and fulfilling a lot of the promises, and that's the concern is, will they fulfill some of the promises on tariffs?
So you saw today that the CPI print here in the U.S. was pretty much smack in line with market forecast. And I think there's an 80% probability that we're going to get a 25 basis point rate cut in December. But a number of Fed officials today were saying there's a little bit of uncertainty over how far the Fed will need to go in lowering rates. I think there's a real concern about overshooting whatever the neutral rate is right now. And perhaps if they were to overshoot, you could get a lot more in the way of inflation.
Yeah, absolutely. And of course, now we have confirmation of the Republican trifecta. So essentially, we know that any sort of passage of tax cuts, further fiscal expansion is likely. And I think that's where the Fed is going to try and stay a little bit more cautious, even though, of course, as Jerome Powell said last week, it's not going to affect them in the near term. But it's obviously something that they're going to continually be thinking about, especially because they're still just trying to get inflation down. And it's moving in the right direction. And that's what the Fed officials are talking about, is it's moving in that right direction. Mm-hmm. But that last mile is just becoming a little bit more difficult.
So let's talk about something that's on the flip side of dollar strength, and that's yen weakness. We've got a 155 handle right now. I think we're waiting to hear something from officials in Japan about the degree to which we have seen this rapid weakening in the yen. Is intervention a risk at this point?
Yeah, the radio silence is quite interesting. But the thing is, it's not only focused on the yen. So nobody everyone's been a victim of the dollar strength, right? So I think that there's sympathy because of the fact that everything is moving in tandem, where you've got Euro, Aussie, everyone is moving, they're all weakening. So there's probably a little bit more of a reluctance to really step in when it's happening across the board. But it has been interesting is what we've seen from the Chinese authorities, and they're pushing back, trying to show that the CNY is not a one-way bet. But I think for Japan, it's just going to be a little bit more difficult, especially given how much it's dependent on what's happening in the U.S.
So you mentioned the CNY. Let's talk about China next. The possibility that we're going to see pretty tough tariffs on Chinese imports into the United States. I would imagine that's a big concern if you're an exporter in China. I mean, to what extent is the currency going to begin to reflect it? I think we had a guest yesterday saying that she wouldn't be surprised if we went to 727 on the offshore. Is that possible?
Yeah, I think at this point, especially because we don't know the extent of how big the tariffs could be, I think that is a very much a possibility of the yuan weakening considerably, and then of course the momentum of that just going even further. But of course, for authorities, not only in China but across the region, it's about the pace of the depreciation. And so anytime they see some sort of rapid rapid pace of depreciation, they will step in at least to smooth out the volatility. We see that all the time in India. We're going to see it in China as well. So I think that's one thing that we should be expecting more in the coming months.
What are some of the other issues that your colleagues on the M-LIV blog are highlighting this morning?
Yeah, I think some of the key things that we're focused on is, is this rally in equity markets sustainable? We've obviously had a few days of a drawback, but the fact is that there's been a really strong momentum behind equities, really strong momentum behind Bitcoin as well. So does that continue? And it's all because of the Trump trades. So how long? What is the longevity of a lot of these Trump trades? And I think that's maybe the key focus of how does this play out. I think for equity markets, the real test for them is going to be NVIDIA next week, because that's going to be the big one.
Yep.
And of course, it will lay out obviously, we're so used to NVIDIA having, skyrocket, amazing results. And if they don't deliver, the market gets upset. So they're going to have to exceed expectation.
It was interesting that you mentioned Bitcoin there. I can remember years ago people saying that you could use this cryptocurrency as a hedge against inflation, right? Yeah. So today we break above 93 grand. Is any part of this trade reflecting concern about rising inflation, do you think? Is it tracking what the long end of the bond market may be telling us just a bit? Or is it something completely different?
I don't think so. I think a lot of that has to do with the fact that you've got a Republican trifecta. Regulation is not likely to come in on a lot of the crypto side. I think there's just a lot of exuberance around crypto because of the new administration and its potential friendliness towards the sphere, more so than an inflation hedge.
Let's talk a little bit about China before I let you go, and the degree to which the equity market is a gauge of positive sentiment. Are you seeing signs now that there is a little bit of upward bias in equity trading on the mainland? And might that suggest that maybe the Chinese economy is bottoming and people are starting to feel a little bit better about some of the policies that the government's pushing out?
So to some degree, when Chinese authorities came out with the share buybacks and the encouragement of share buybacks, they've put a floor under equities to some degree. And of course, when you have the national team coming in, when they do, when there is a stark sell-off. So there has been a bit of a floor. In terms of the policies, I think the market has essentially been disappointed overall in how much, in terms of, we haven't gotten anything really on pushing consumer demand. We haven't gotten anything in detail about what they will do on the property supply stuff. So I think they're talking about next year we'll get more forceful measures, but you and I know that the market tends to be impatient. So we've got a lot of foreign investors moved back into China, but if it doesn't deliver, I think they'll get impatient again and start pulling out.
Mary, thank you so much for playing along. It's always a pleasure to visit with you. Mary Nicola is Bloomberg M-LIV strategist joining us from Singapore here on the Daybreak Asia podcast. Joining us now is Chris Carey. He is portfolio manager at Carnegie Investment Counsel, joining us from Cleveland, Ohio. Chris, thanks for taking time. I'd like to get your take to begin with on what the incoming Trump administration means for not only markets but the economy as well. Now, one of the things that's been striking here since the election has been this rally in Bitcoin. I think it is up about 35% since the president-elect's victory. What do you make of what Trump means right now for financial markets?
I definitely think that the Trump administration is definitely welcome to financial markets, especially with regards to some of the dampening effects we had over the last 4 years with regards to Lina Khan and her tenure at the FTC. I think that the negative pressures that there were in terms of the M&A environment, it's going to be good to be able to see those lift, especially for large cap tech. I think that's definitely a benefit. And then also on the tax side of things too, I think the continuation of the Tax Cut and Jobs Act, potentially even lowering taxes even further for corporations, it's definitely obviously going to support their bottom line. I think that's reflected in the markets. It's going to be interesting to see, though, kind of with everything when it comes to that, whether he's going to actually go through on what actually he says.
But isn't there some concern about the potential inflationary impact of some of these policies? I'm looking at the behavior of the bond market and just watching yields back up since the election. Does that concern you?
Yeah, I mean, I think there's definitely some concerns that his policies could be inflationary. But I guess the other side of the coin is that when you're able to stimulate economic growth, you don't have to cut interest rates as much as you might have had to. So I really do think it's only going to be a matter of time until we see what really is going to be the reason why rates are rising. If you're looking at inflation, I mean, 18 months ago we had 9% CPI. Now we're down to 2.6%. That's a job well done as is. I know the Fed targets 2%, but 2.6 for CPI that we got today is still pretty damn good. I also think with regards to the threats, the tariffs, it's you say one thing, but is that actually going to be what he follows through with? I think they're probably going to be used more as a negotiating tool than actually seeing these widespread tariffs being slapped on, which would have inflationary effects. But there's definitely fears. You're definitely starting to see that.
Well, you were talking a moment ago, or alluding to the fact that we may be seeing less regulatory risk when it comes to big cap tech, but I'm wondering about the financials as well. Could they perhaps benefit from less regulation?
Yeah, definitely. They're definitely poised to benefit from a less regulated landscape. The economy still is strong. If we're able to avoid those significant loan losses, I think that's fantastic, as well as encouraging more consolidation within the banking space. Large cap banks still trade at pretty appealing multiples. I think that and that's reflected in the chart. And it's not just banks too. I think that the whole financial sector as a whole does stand to benefit as a result.
One of the things we were talking about yesterday was this Department of Government efficiency that the president-elect is putting in place. Elon Musk will be working in conjunction with Vivek Ramaswamy, and the two are going to be tasked essentially with looking for ways to cut excess regulation, to reduce wasteful expenditures, and restructure some federal agencies. That's pretty ambitious. Do you think they're going to make a lot of headway with this?
It is definitely a remarkably ambitious thing that they are undertaking. I think they will probably be able to make some headway. The fact now, though, is that the federal budget has just ballooned, and we're at a point now where interest payments are making up more of the budget than defense is. I think that it's great that we are finally paying attention to the deficit. It's really going to be the case, though. We've had decades of complaining about a ballooning deficit. Someone's going to try and do something about it. If they're successful, that's tremendous. And being able to chip away at that, there are tons of inefficiencies in the fact that the government pays insane multiples for goods and services that you and I would pay as business owners or consumers. So I definitely think there is definitely some fat that can be chopped off. The magnitude of those cuts we'll only be able to see with time. But as silly as the name is, and I think that it's definitely welcome. And I'm going to be very interested to see what they're able to actually pull off. Like a lot of the things that have been promised that led to Trump getting elected. You can talk the talk, but can you walk the walk?
Yeah, most definitely. Maybe we can talk a little bit about what you're seeing offshore. One of the things that's happening in China is the early, maybe green shoots of some sort of recovery. We know the government has applied a lot of stimulus, but I think there are a number of analysts that agree that the risk right now to a recovery in China is being a bit derailed by the possibility that these threats of tariffs from President-elect Trump would be very real, targeting obviously those Chinese shipments, exports from China to the United States. Do you think this has the potential to hold China back in a very big way?
I definitely think so. Tariffs or not, you're already starting to see that companies are diversifying their supply chain away from China to begin with, to other places in Asia. Mm-hmm. I think that the threat of tariffs will have a material impact on the Chinese economy. I think that analysts are right to be concerned about it. It's one reason, another reason why at our firm we prefer to favor U.S. stocks versus international, especially we barely have any exposure to China. just because, they're such an export-driven economy and they rely so much on the United States. I think it's definitely a very big risk, and I wouldn't want to be exposed to China at the moment.
So if you're favoring U.S. markets right now and assuming that we're going to see a continuation of economic growth, maybe a little bit stronger growth, given a lot of what we're expecting from the incoming Trump administration, I'm wondering, Chris, whether you want to be more exposed to companies that are particularly economically sensitive in the small cap space.
Yeah, definitely. I mean, small caps have definitely had a pretty tough time. Prior to the last, I'd say, month or so, based on the fact that interest rates are high. I think that the fact that we're starting to see those cut, we just saw that based on the CPI figures, that there was no upside surprise, that the chance of another rate cut in, December is now up to 80%. I think that's terrific. I think that definitely, provides some upward momentum for small caps. Overall, though, I think that, the US is the best place in the best place in the world to do business. It's why the vast majority of companies are founded here. We have great, regulatory environment, legal environment. All the best companies are set up here. I think that especially with Trump coming into office as well, it's likely that US markets are going to outperform international markets like they did, in Trump trade 1.0, if you will. We do have the strongest economy, and I think history indicates stronger returns for U.S. equities, at least relative to their global counterparts.
Since the election, I think we can agree that there's been a pretty powerful rally in risk assets, and I'm curious to get your take as to whether or not there's some vulnerability here, that maybe we've come pretty far in a short period of time and a pullback might be in order. Is that possible?
We've definitely come pretty far. I would also say, though, that even though we're up, 24, 25%, strength begets strength. It's, I think, over the last 100 years, 18 of those we've had the S&P has ended up plus 30%. If you take that down to anything above 25, it's a quarter of all years going back that period of time that have been up there. And when you have the equity market up 25% in a given year, typically the next year returns from there are still plus 8, plus 10%. I definitely think that maybe in the short term we're a little bit overbought, and there definitely is some exuberance, but I think that we are re-rating for potentially a much more favorable business environment. So it doesn't really affect our long-term positioning in terms of being long U.S. equities.
Chris, we'll leave it there. Thanks for joining us. Chris Carey is portfolio manager at the Carnegie Investment Council, joining from Cleveland, Ohio, here on the Daybreak Asia podcast. This is Bloomberg Daybreak Asia, your morning brief on the stories making news from Hong Kong to Singapore and Wall Street. Look for us on your podcast feed every day on Apple, Spotify, and anywhere else you get your podcast. Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. Plus, listen coast to coast on the Bloomberg Business app, Sirius XM, the iHeartRadio app, and on Bloomberg.com. I'm Doug Krisner. Join us again tomorrow for all the news you need to start your day right here on Bloomberg Daybreak Asia.